So resources are scarce. This is something that we discussed when we did your zoos. This is the ultimate reason why people make decisions, why people have to make choices. Everything is scarce. One of the biggest resources we have is time, and time is obviously extremely scarce. It is impossible to find a resource that is not scarce. Um, you can try, you can say things like sunlight, or you can say things um, like salt water, but even those are scarce. Air is scarce. Everything is scarce to some degree, and therefore choices have to be made. And a resource, when we discuss this, resources are anything that can be used to produce something else. So whenever we use resource in economics, it's anything that can be used to produce something else. We split our resources into four different factors of production. These are the only resources that we are going to talk about in here. So land is a big one. This is all of our natural resources. So don't just think of it as farming land, think of it as the minerals in the ground as well. Labor, this is the one that we are going to focus the most on when we do factor markets. This is the effort of your workers. Capital, this is machinery, buildings, tools, and anything else that's used to make other goods and services. Um, a lot of people might confuse things and use money as capital because in common terms in finance we say, do you have enough capital, and we need money for that. In economics, that is not the term we use. When we say capital, we mean machinery and buildings and things like that. Entrepreneurship, this is sort of that special spark. It's the risk taking, it's the innovation, it's the organization of your resources. This is your higher level managers. Now, obviously, entrepreneurship is going to be really, really difficult to measure and to graph. So we're not really going to be paying much attention to entrepreneurship. We'll be paying attention to the other three, though. You could graph any of them using the same basic setup. Our main focus will be the labor market when we get to factor markets much later on in the year. Now, resources are scarce when there's not enough to be able to satisfy the various wants that society has. Scarcity forces us to make choices as a society, which leads us to our basic problem of economics, which is that you have scarcity and choice, and that is what economics is at its heart. Now, there's two different setups that are tested in the AP curriculum. One is the market economy, and that is sort of what we have in America. It is that production and consumption are decentralized, and that many firms and individuals have a stake in it and are able to make choices. There is no central authority telling people what to do, where, how much to produce, where to ship it, and things like that. In order to do this, you need strong property rights. If you ever wonder why in America people are so crazy about their property, it is deeply ingrained into us that we need strong property rights. And that's part of our capitalist and market based economy. It's the idea that when you have strong property rights, you have all of these incentives for people to make those properties better. If you don't have strong property rights, nobody really has a desire to uh, make things better for other people. I mean, you do have your occasional altruistic people, but as a society as a whole, we have way more free riders than we have um, altruistic folk. The other side is the command economy. This is the closest to a USSR economy. This is where industry is publicly owned, so it's owned by the government essentially. And then there is a central authority making production and consumption decisions. Now, in reality, there is no pure market, there is no pure command economy. It's everything's mixed to a degree. You have to think of economies as sort of a sliding scale, and every economy exists somewhere on that scale. You might have your command economy on one side and your market economy on the other, and we're all kind of somewhere in the middle. In microeconomics, this is our focus on choices made by individuals, households, or firms. So this is what we're studying this year. Um, so whenever it's something about an individual question, an individual person, an individual market in terms of your healthcare market, that would be a microeconomic thing. Um, that's what we're going to focus on. So anytime you can get it down to an individual person, producer, or industry, that's microeconomics. For macroeconomics, that is the overarching economy. So any indicator that goes across many, many different industries, that is a macroeconomic problem. This is what we are not studying in this course. We'll be doing it next year. So if you want to take my course next year, if you're a junior or a sophomore, you can do that. So in that course, we talk about unemployment rate, inflation, GDP, things like that, things that go across all industries as opposed to just a single one. The other two ways you can break up economics are by positive and normative economics. So for positive economics, this is when you have a statement that can be proven by facts. There's no argumentation there. It is something that you could literally point to the data and say, this is what happens. So in the example here, we should cut taxes in half to increase disposable income levels. That is something that will absolutely happen. When you cut people's taxes, that means that they have more money in their pockets. That is disposable income. So that is a positive statement. On the other side of things is normative economics. This is about a value judgment. So if you see the word should, that's normally an indicator. If it's something that you feel like you can argue against, then it is a normative statement. So in the example here, tax cuts would improve the quality of life for every Invest American. That is a normative statement because you could definitely argue that tax cuts would not improve the quality of life for every person. I said every weird. But you could definitely argue that it doesn't help every single person. Some people rely on government programs that are funded by those tax cuts, for instance. So if you cut the taxes, then those people will be worse off. So that's the difference between positive and normative economics. On the AP test, those two don't come up a whole lot, but you might see one or two questions based off of them in multiple choice form.